Hi everyone, a very good afternoon. You're watching the Money Show's Budget Hotline special where we are going to be decoding all the fine print and the nitty-gritties of Budget 2020 as was announced by Finance Minister Nirmala Sitharaman, and more specifically on the topic of personal taxes and direct taxes, because that is something that all of us had our eye out on. After all, that's one topic that impacts everybody from you and me and even the richest man of the country. So to talk about that and more, I have with me Homi Mistry of Deloitte India. Mr. Mistry, thank you so much for joining in on the Money Show. And like I said, there was a lot of focus on personal income tax. In fact, even before the budget, you told me that personal tax is going to be the topic to talk about. But I suppose everything is not happy news in the topic of personal tax for all our individuals out there. So largely, just to set the context, what did you make largely of all the personal tax provisions? And then we can start off with the nitty-gritties.
Right. So I think the main one is about this new scheme, whereby you can go either under the old regime and claim certain deductions that you are already getting and pay tax at the normal rates, or you go under this new regime which has been announced yesterday.
Yes.
But then you have to forego certain deductions, certain exemptions, etc. But then you have to pay tax at a lower rate. So before one can even take a call like this, whether one should go under the old or the new, they would have to do a comparative analysis. What were they paying under the old regime? What was the income under the old regime? What are the taxes under the old regime? Vis-a-vis now, what is going to be the tax under the new regime? So the tax rates will be lower, but you'll have to forego a whole host of such exemptions or deductions. So for example, in the past, there were a lot of popular kind of deductions, especially for salaried employees. They would claim an HRA exemption. They could claim exemptions even for leave travel allowance. They could claim exemptions under the popular section ATC for PF investments or Provident Fund, Public Provident Fund investments, etc. They could claim deductions even under the other section for NPS.
Yes.
They could claim deductions for tuition fees. They could deductions even for payments made under ELSS, for life insurance, etc. And even for medical insurance, etc. Even savings interest was exempt up to 10,000 rupees for an individual less than 60. And an individual 60 years and above could claim up to 50,000 rupees for interest on fixed deposit, etc. So now all that, if you want to go under the new regime, you can definitely go, but then you'll pay lower tax, but you will forego all those benefits, all those deductions, all those exemptions.
So these are the most commonly used exemptions.
Correct.
I mean, I think almost everybody will be having that EMI that may be paying out on the house. So 1.5 lakh rupees gone, plus another 2 lakh rupees on the interest as well gone.
Correct.
LIC, PPF, I think these are and everybody has a PPF account as well running, I mean, that's one of the most commonly owned savings schemes. So, I mean, if I look at it that way then, for a 5% benefit that I'm getting in the new tax regime, I don't see why I should let go of all these payments I'm making and the tax, the tax benefits available because of that.
Even if you're a salaried employee, you were getting the standard deduction up to 50,000.
Exactly.
And there was no investment. You were getting it. Even that will go if you go under the new regime. So my advice would be to somebody that please analyze your income, your estimated income from starting from April 2020 onwards. Estimate it, see what the tax is going to be under the old regime and see what's going to be the tax under the new regime. One other important factor that we'll discuss later, but that's also to be considered, because when you estimate your income, it's not only going to be your salary income. There could be income from house property, if you let out property, there could be some gains, and now the government says we are also going to tax the dividends that you receive from corporates or dividends that you might receive from various mutual funds. So that's also a factor to be borne in mind. One would have to estimate that kind of income, etc. So one should start working on it maybe from this month itself, so that one is ready from April onwards.
For the next fiscal year.
Right.
Yeah, that's April 2020 onwards. Yeah, mind you, by the way, for all our viewers, it's important to note that this tax option is available for the April 2021, March 2021 fiscal. So it's not this fiscal, it's the next fiscal, just in case if our viewers were unaware of that. Okay, so, in fact, FM Sitharaman in her budget speech mentioned that the tax structure right now in India is very complicated, and an individual finds it extremely difficult to file their returns, without taking the help of a tax expert, and hence these, the second option. But I suppose it's raised more questions in the minds of individuals. She has said that there were some 100 exemptions in the current act, and I think 70 will not be allowed in the new option. So what are those few 30 that are actually allowed? I mean, have you all checked on that?
Yeah, there are a few which you may still get currently. For example, one important thing which you can still get is the investments that the employer makes under NPS.
Okay.
So currently when an employer makes under NPS, up to 10% of your basic salary is not taxable.
Okay.
It's tax neutral when the employer makes that contribution.
Okay.
So that will not be hit by this. And for central government employees, it's not 10%, it's 14%.
Okay.
So that is one important factor. There are other things also. For example, if you get these kind of leave encashment or you get these VRS benefits at the time of separation, etc., even that will not be liable for any kind of, you won't be affected by this under the new regime.
Okay. But it's, I think, it's mostly employers contribute their, it's mostly to an EPF. It's very rarely to an
Correct.
NPS. So maybe as an employee, if I do want to switch over to the new option, I can tell my employer that, you know what, maybe I want that 10% cap of my salary to go into a national pension scheme. So if I'm getting that little bit of deduction when I switch over to the new scheme, and if it's working out, I'm getting adequate savings, then why not? I suppose that could be an option available, for our employees. Now, since I am on the topic of contribution to Provident Fund, this is something that FM Sitharaman did not announce, and that's why we call it devil in the details. There's a cap now on the Provident Fund as well, if you could elaborate on that.
Right. So what the law says as of today, that if an employer contributes to an approved superannuation fund in excess of 1.5 lakh rupees, that excess is taxable in the hands of the employee.
Okay.
Up to 12% of contribution to a provident fund, employees' provident fund from the employer is not taxable.
Okay.
And up to 10% for an employer other than a central government employer. And if the central government contributes, that's up to 14%. Those contributions would not, under NPS, would not be liable for tax.
Okay.
What the government is now saying is that people in the low income, unfortunately, these kind of contributions will really not be possible. Because they really wouldn't have that kind of money. The employer would not have that kind of money to sort of contribute for all of them.
Okay.
So the people in the higher category, they are getting benefits by way of higher contributions to Employers' Provident Fund or to Superannuation Fund or even to NPS.
Okay.
So the government says it wants to propose to change the law. And it says if the combined contribution for NPS, for Employees' Provident Fund and for Superannuation Fund by the employer exceeds 7.5 lakh rupees.
In 1 year?
In a year, in a fiscal year, then that is going to be taxed. And they have also stated that if you get any kind of income on that, supposing some interest or some dividends or any kind of similar accretions to that, on the taxable portion, even that is going to be taxed. We'll have to wait and watch because they will have to come out with certain guidelines, rules and regulations in connection with that.
This is even if I'm not withdrawing my PF.
Even if I'm not withdrawing. It's a contribution being
Okay.
made by the employer.
Okay, and even if that interest, I'm not yet withdrawing the PF, it'll still be taxable if it exceeds 7.5 lakh.
If it exceeds, along with the other contributions.
Other contributions,
But we'll have to wait for the guidelines to see how they're going to determine this interest and the other accretions.
Exactly, yes, because I think that would be a bit of a complicated calculation. I mean, do you do it on the balance above 7.5 lakh rupees, or is it going to be on the entire corpus? Because I suppose if it's on the entire corpus, then that could be quite a hefty amount.
Although what the rule says right now, it seems to be only on the taxable part of it.
Okay, so let's say, hypothetically, if the employer's contribution, let's say, is 8 lakh rupees, so it possibly will be only on the 50,000 rupees.
That's possible.
So we'll have to still wait for the guidelines, but just for the government to confirm this.
Correct.
But I suppose all our high income earners and high salaried earners will be hoping that it is, if that's the case, essentially. So effectively, to understand the implication of this new rule of the Provident Fund bit, who would you say is at a loss, and does any individual, any salaried person stand to gain with this new rule?
No, so with this kind of new rule, obviously people who were earlier not paying tax, and once this threshold is crossed, they're going to pay tax.
So high income earners.
So that's what the focus is, on the high income earners.
Okay.
In certain other cases also, for example, many foreign nationals, when they come to India, they come from a country where India has not signed what's called a social security agreement. For example, let's say they come from the US or from the UK, and India has not signed a social security agreement.
Okay.
They also have to contribute mandatorily to India's Provident Fund. And that could be a significant amount because it's a 12% on a basic amount. You know, it's a big amount. Very often the employer picks up that tab also.
Okay.
Not only of the employees, tab is picked up by the employer.
By the employer, all right.
So, you know, that could also increase the tax effect on that.
Just a quick question. The employer's contribution, is that included in the CTC of the employee? No, right? That's an over and above contribution?
Yes, employers generally what they do is that they will factor in even the employer's contribution to PF, and to even superannuation fund.
Okay, and they say that the whole thing
this is your CTC, yes.
Okay, all right. So that depends, you know, company to company or what
Correct.
the contract, the agreement is, the employee agreement is. Okay, fair enough. So I think largely, as long as the Provident Fund, superannuation fund contribution, NPS contribution
Correct.
together is under 7.5 lakh rupees, you're fine.
Correct.
It continues to stay exempt, of course, until the time of withdrawal, or if you're not working, that's when it gets taxable. But when it goes above 7.5 lakh rupees, then it's a problem. And I think, Mr. Mistry, safe to assume it's a very small percentage of the population who get a contribution of 7.5 lakh rupees from only the employer.
Correct.
Right?
That would be a small population.
Okay, all right. So I suppose a majority of the population right now at least doesn't have to worry. It's, you know, the higher earners that would have to sort of look at this provision very, very carefully. The other part I wanted to talk to you about is the laws with respect to residential status, because there have been tweaks over there as well. And I know a lot of our viewers out there may be unaware, but you know, there is a resident, then there is a non-resident, and then there's something called as resident, but not ordinarily a resident.
Correct.
And, you know, frankly, it sort of did jog my memory back to when I was studying this, which was almost about 10 years ago. But yeah, what exactly is the new provision for these three categories?
Right. So what now the new provision states, and there are some distinctions mentioned. Earlier in the case, if you were an Indian citizen or a person of Indian origin who was living outside the country, and used to come on a visit to India. You could come on a visit to India for a period of nearly 6 months, about 181 days, and you would continue to be not taxable on your foreign income.
Okay.
You would still be classified to be like a non-resident.
So roughly 6 months.
About 6 months.
Okay.
Now what the government says is that a lot of people have been coming,
Yeah.
they've been trying to manage their affairs. The sort of stateless people, they're not paying tax here, they're not paying tax anywhere else.
Yeah.
That's not acceptable. So what they're saying, on the one hand, now we want these people to reduce the pattern of stay in India from 181 days to only 120 days.
So 3 months.
4 months, you could
4
say.
months, pardon me. Yes, yes.
So if they're in India about for about 119 days, it's still fine. But if they go above that, then they could become a resident.
Okay.
So that is one condition. The other condition that they've also brought in is regarding, again, this concept of a resident, an ordinary resident and resident, but not ordinary resident, as you mentioned. In the past, there were two conditions, either of the conditions if you fulfill. If you were non-resident for 9 out of 10 previous years,
Okay.
then in that case, you could be classified as a not ordinary resident.
Okay.
Or in the 7 years preceding the relevant year, you were in India for a period of less than 730 days.
Okay.
You would be classified also as a not ordinary resident.
Okay.
So if you satisfied either of these conditions, the advantage was that you were not liable to pay tax on your foreign income. That's the
on your foreign income. Okay.
That's the advantage of being a non-ordinary resident.
Okay.
But now what they say, they want to change the system.
Okay.
And they want to say that if a person is a non-resident, instead of 9 out of 10 years, 7 out of 10 years is a non-resident.
Okay.
Then in that case, the person would only be a resident but not ordinary resident. And this other concept or limit of 729 days is has been done away with.
Okay, so I suppose it's become easier for individuals to categorize themselves as not ordinary residents.
Not ordinary. So, but this is now going to be the new test starting from April onwards.
Okay.
And there's been another change also. What they are saying, there are certain people, individuals, etc., who live in other countries. They're not liable for tax in other countries, maybe by reason of their residence or their domicile, and they are Indian citizens. So they want to categorize such people who are not liable to pay tax in a foreign country and a citizen of India as residents of India.
But they would be NRIs.
They would be, now they are going to be classified as residents.
Okay.
So, for example, if you're in a country, let's say like in the
You know what, Mystery, hold that thought. I just have to take that very short commercial break, but we'll be right back with all of those details. Guys, stay tuned. It's certainly something that all our NRIs watching should take note of because this is something that will change your tax liability status in India. Don't go anywhere. We'll be continuing this conversation. Welcome back. We're in conversation with Homi Mistry of Deloitte to talk about the fine print with respect to personal taxes in the budget. And we were talking about something called residential status. We just had a discussion on what exactly do you mean by resident, but not ordinary resident. And now, of course, that new provision, Mr. Mistry, is where your income is going to be taxed in India if you are not paying tax in the country that you are residing in. So yes, you were talking about how that works. Could you continue that?
Yeah. So what now the law is proposed to be amended to state that if I'm a citizen of India and I'm not liable to pay tax in a foreign country, I will be deemed to be a resident.
Okay.
That's what the law says. So maybe they're looking at people in certain countries. For example, it could be the United Arab Emirates,
where you're not paying tax.
Yeah, or it could be in other other tax havens, etc.
Yeah.
Now here also the question which comes up, and there have been judicial decisions, etc., to say that if you happen to be a tax resident under a tax treaty that India has signed with a foreign country, even though you may not be paying taxes, etc., and you can obtain from a foreign country's government a tax residency certificate to say that you're a tax resident under the treaty, under that country's rules and regulations, then that's also a question that one will have to see. Because the point there is that under the judicial decisions, and even there's an old CBDT circular to say, if the tax treaty is more favorable than the act, then the treaty can override the act.
Okay.
So you could still continue to be, under the treaty, a resident of that country.
Okay. So this would depend on a case-to-case basis?
Case-to-case basis, and documentation, etc., is very important because the Income Tax Act says in such kind of cases, you should be able to show that you happen to be a resident and you must have necessary evidence to show that you're a resident in that country.
Okay, all right. So that part, I suppose, is a little bit complex, and it's something that every individual will have to look at. They'll have to go through the laws. They'll have to see what the tax treaty is. And of course, if it's favorable over the Income Tax Act, then the treaty would tend to proceed over the act. Okay. Very quickly then, Mr. Mistry, I want to talk to you about DDT. I suppose, income earners from the lower tax bracket would have reason to rejoice, Mr. Mistry.
Yes. So, I mean, the recommendation to abolish DDT has been going on since some time, and finally the government has decided now to completely abolish DDT, whether on distribution of dividends by a domestic company or whether any kind of distribution of income by even a mutual fund. So what's going to happen now? A mutual fund is not going to pay this tax, this dividend distribution tax, neither is a domestic company. But now it's going to be taxed in the hands of either the individual shareholder or in the hands of the unit holder.
Okay.
And they would pay tax at the normal rate of tax that they would be paying. So for example, now let's say we got new tax rates like 10% or 15%. So in those kind of cases where the mutual funds, etc., if they were paying a tax at a higher rate, let's say 25% or 30%, and the individual pays tax at a lower rate, let's say at 10% or 15%, obviously he or she is going to benefit. But if you're going to pay tax at a very high rate, let's say at the rate of 40, let's say the super rich, at the rate of 42.74%.
Including surcharge.
Including surcharge and cess. Or at the rate of 39%, just for example. Then in those cases, the individual obviously will have a higher tax outgo. So it'll depend from case to case. You'll have to see your income, what is the dividend being distributed, etc.
So but this will be added under the head of income from other sources.
Income from other sources, correct.
All right.
And what the law also prescribes is that in case any kind of dividends are being distributed by a domestic company or by the mutual fund and it exceeds 5,000 rupees in a year, then of course the domestic company or the mutual fund will also have to deduct tax at source at the rate of 10%.
This is only a mutual fund has to do this?
Mutual fund as well as an Indian company distributing dividends.
Oh, okay. So there'll be TDS now on
There'll be TDS at the rate of 10%. Of course, you can claim a credit for the same.
Credit for it, of course, yeah.
So this will be something which will really benefit. Many of them could be foreign investors. Because it was one of their demands is that, Indian companies are imposing this, but we are not getting a credit in our home country as per our rules there. So if you have a withholding tax, and India's got tax treaties with several countries, so at least we can claim a credit back in our home country. So it will definitely benefit them. It will definitely benefit people also in the lower categories. But if you're in the high category, you will have to obviously pay more tax. There is another concession given, but that's to a very limited extent. In case you borrowed money and you've invested, let's say, in shares, etc., or mutual funds
to buy those shares,
those shares, and you get dividends or you get these income from these units, then you can claim a deduction for the interest. But that's also capped at 20% of the interest. It's not the entire amount.
Not the entire amount. So I think that would have a very limited impact as such. Okay, all right. Very quickly, we just have 2 minutes left on the show. And I want to discuss that last bit on personal taxes with you, and that's the ESOP for startups. So very quickly, Mr. Mistry, for our audience watching and for all those, startup owners, entrepreneurs, what's the provision there?
Right. So now, basically, currently the provision for taxing ESOPs or stock awards or what they call sweat equity shares is at 2 stages. One is when you exercise and they're allotted to you, so you pay at that time a perquisite taxation. And subsequently, as in when you sell them, you would also pay a tax. So this is as capital gains. So it's like a 2-legged taxation. Now what the law says is, especially for startups, etc., certain startups, is that when these shares, etc., are being allotted to employees, they will have to pay the tax, but they will not have to pay the tax immediately. The tax would be deferred for a period of what they say 4 years from the end of the assessment year, or when you actually sell the sweat equity shares, or if you leave the organization. Then you'll have a taxation and the company will have to deduct tax within a period of 2 weeks from the end of that particular period. So, but they will have to pay also tax based on the tax rates in force at the time when the stock was allotted to you. So you may get an allotment, let's say, in 2021, but your deferment could be 4 or 5 years later.
So basically it's just a delay in the payment.
It's a delay because what they were saying that if you ask me to pay tax right now and I don't sell my shares or stock, or I'm not able to for whatever reason, I'll have a cash flow issue. So at least in this case, money will come into their hands, or they'll have time to gather the funds and pay the tax.
And pay it. So just a deferral, basically.
It's a deferral.
Nothing. So largely, just to summarize our conversation, Mr. Mistry, would you say that this, all the provisions, roughly, if I have to look at it, are, I think, is something that would that high income salaried individuals would not exactly like, if I have to just summarize the entire conversation?
Yeah, from their point of view, obviously they would have to pay more tax, or if they're getting high dividends, etc., then they would have to pay more tax, especially in the higher category.
But still, for the lower income individuals, I suppose that's something that anyway Mr. Sitaraman has focused on. More or less status quo, very few perks given here and there, I suppose. Okay, great. All right. Thank you so much, Mr. Mistry, then, for joining us and decoding all the personal tax provisions announced in Budget 2020. Folks, I hope you enjoyed this conversation and, of course, learned from this interview as well. We will wrap it up on this edition of the show. Many thanks for watching. Stay tuned to ET Now.